As far as upside, the key trigger for us has been the spread relationship between silver and gold. Right now, the spread between silver and gold is at 1.2%. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. We have a situation in silver where, for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here?
Gold and silver markets continue to show remarkable resilience as investors worldwide look for safety amid ongoing global uncertainty. With central banks increasing their gold reserves and geopolitical tensions rising, the metals are once again proving their role as real stores of value. Despite short-term pullbacks, recent data suggests institutional buying remains strong. In today's discussion, a leading market analyst, Michael Oliver, breaks down why current price movements aren't signs of weakness, but rather part of a healthy consolidation before another surge. He emphasizes how underlying momentum indicators continue to strengthen beneath the surface, suggesting that both gold and silver are coiling for a breakout that could catch many off guard. The long-term picture remains clear. These markets are far from finished, and the real move might still be ahead. If you found this analysis valuable and want to stay updated on the unfolding story in gold, silver, and the global economy, don't forget to like, share, and subscribe to the channel, where truth meets market insight before the headlines do.
All norms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where, for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, going back to the 1970s, and you'll see that they were in a range, 1970s, 80s, 90s, into mid-2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here? We know silver's in great demand by high technology. Solar panel production, Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver. Microscopic but pervasive, okay? It's a great conductor. And we know for 5 years now, the new supply has not met demand. There's been a deficit 5 years in a row, supply-demand deficit. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver is just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also if you go back and look at 1980 high at 50 or 2011 at 50 and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade, 90% increase in the quantity of M2, you know. Well, if you factored that in, silver probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality. The problem with getting over 50 recently is we surged from a low under 30 in April. Okay, started to come back up in May, and in June got back up to 34 plus, had two prior highs at 35, May last year, March of this year. So in June of this year, came back up to 34, headed toward those highs, and momentum said you're going to break out and you're going to explode. It's significantly different than what you've been doing instead of incremental. Well, sure enough, you went from, what, $35 to 53 in what, a handful of months? I think it deserves a correction. Plus, when you took out the 50 high, what happened? Every idiot investor out there who thought the two highs at 50 were meaningful. Again, nominally they are, but in real terms they're meaningless, real dollar terms. They got sucked in to buy it finally. And so you had latecomers come in at 52, 53, and they bagged them. Good. Should have been bagged. They should have been buying silver in the 30s or the 40s or the 20s even. And when they bought high, it created a vulnerable group of people. And so that's a logical place to have finally a correction that you could call a correction.
Gold and silver prices have been on the move again. Over the past week, gold has hovered near recent highs as investors digest renewed fears of inflation and slowing global growth. Meanwhile, silver continues to attract attention for its industrial demand, with analysts noting growing supply pressures as global manufacturing shows signs of recovery. Central banks remain steady buyers of gold, while market volatility keeps safe haven assets in focus. In this backdrop, one of the most respected market analysts explains that what we're seeing now isn't exhaustion, but strength beneath the surface. Momentum indicators, he notes, continue to favor the metals, even as traders question whether a top is forming. He points out that gold's structure suggests more upside potential once short-term consolidations fade, and that silver could soon follow in a powerful breakout phase. Now, let's go back to the interview.
The pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down and then it's wheel spinning. When we examine the short-term technicals of silver, you know, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to $40 or 41 or whatever, you know, and this is the this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, you know. The surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold. The spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. Did anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, oh, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued, and investors just say, phooey with that market. It's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say look at the silver-gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from above 1.2 to 1.32% to be precise, to break out, momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI, tech related. NASDAQ 100, the same symbols, 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, et cetera, far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, et cetera. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back into its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an 8-fold bull market to get to those highs. We're only fourfold right now. The game is not over. The game is just beginning. Watch the spreads.
As the dust settles in today's markets, it's becoming clear that the precious metal story is far from over. Gold continues to signal strength beneath the surface, holding firm even as interest rates fluctuate and investors chase short-term gains elsewhere. Silver, often underestimated, is quietly building momentum of its own, a reflection of both industrial demand and deepening investor interest. The undercurrent suggests this isn't the end of a cycle, but a recalibration before the next powerful wave. We're entering a period where patience will define winners. The signals are subtle now, but history shows that such calm often precedes explosive moves. Gold and silver remain the anchors of financial truth in an age of paper uncertainty. So as markets shift and narratives change, one thing remains constant. Real value always rises to the surface. If you want to stay ahead of the curve, understanding the moves before they make headlines, make sure to like, share, and subscribe to the channel, where insight meets integrity and the future of gold and silver unfolds one truth at a time.